I don't usually come to you guys on a Saturday and bring you emergency shows, but these are the scenes on the NASDAQ as we're experiencing a global market meltdown. As you can see, yesterday, $2.9 trillion was wiped out of major indices and stocks due to fears of a growing recession. What you also saw was the NASDAQ breaking below its 1 year up only trend line. We're now below the 1 year up only trend line. And it's not contained to the west. If you look in the east, it's the same picture. These are the Nikkei. The Nikkei index is a Japanese stock market index, down 20%. And if you look at how the US dollar is doing relative to the Japanese yen, it's a shit show. The contagion is also spread to crypto. I mean, just look at the banter bubbles for today and look at the banter bubbles for the week. Look how bad tokens like Render has been hit 25%, Rune down 22.5%, Near down 21%. You can also see, if you look at Bitcoin dominance back at 56.5 as people rush back for safety. So in the midst of this global meltdown, I thought I'd come here on a Saturday morning and I'd give you perspective and show you exactly what's going to happen from now and what's going to happen to your crypto bags and whether you should be moving around. So Saturday morning stream, guys, let's do this. As I said, it's very, very, very rare for me to do a Saturday morning stream. I like to spend the time with my family and my kids, but when I saw the shit show on the markets late last night, I thought I better come back and I better do a stream for you guys, and we better just put this shit show into perspective, okay? Because this does look very, very scary. What I need from you guys, though, is because this is a very, very, very unscheduled stream, I need you guys to smash the like button. I'm going to wait here for 2 seconds while you guys smash that like button and just let everybody know that there is a stream going on. Because with the unscheduled streams, the YouTube algorithm doesn't know we're streaming. And because it doesn't know we're streaming, it doesn't invite people. Now, if you smash the like button, it kind of wakes up that algorithm and tells the algorithm, okay, these guys are here. These guys are streaming and they're doing some good work. And then it starts circulating the video. So please, guys, smash that like button and let me help you guys put everything into perspective. It is quite scary out there. We have heard the word recession used a lot. You can see that it said that it was the worst day for stocks since the March 16th, 2020, which was the COVID pandemic fears. And the reason why it's all happening is because of growing fears of a global recession. Anyway, let's get into it. I see the likes are going up, but let's get into it as quickly as we possibly can. So what actually happened? Why are we where we are? And why do we have this picture right here on the stock market? Well, what you can see is that is what happened. We see that the NASDAQ actually broke down below this 1 year long trend line. So we've got this upward trend line that's been happening since the 30th of October 2023. And if you measure the move up from the 30th of October 2023, we went up 50% on the NASDAQ. We went back down, and now for the first time, as you can see, we broke down below this trend line. If you look at some of the biggest stocks in the NASDAQ, I mean, this is Nvidia. Nvidia, one of the biggest companies in the world, if not the biggest company in the world, down 26% in the last 30 days. You've also got Intel. I mean, just look at Intel. Intel is down 45% in the last 30 days or so, or this year. And specifically, Intel is back down at prices that it was in 2016. I read this from Genevieve, who says, "Good morning, everyone. It's tough out there. Amazon down 8% after missing earnings. Intel drops 20%. Snapchat down 30%. Magnificent Seven swung $3 trillion in market cap in the last 3 weeks. The VIX is up 20% this week. Investors are worried that the Fed has been too slow again on rate cuts. You got 𝗥𝗚𝗢𝗢 says, Intel shares are now down 27% today. This is the worst day for Intel since 1982. Another one here. The Dow Jones Industrial Average is now down over 1,500 points since Wednesday. So big move. The S&P is down 3.5%. Then you got Ben Cowan, who says that the SPX, which is the S&P 500, is now exactly on its bull market support band. So that is where we are. So you can see the S&P 500 there. You can also see that in the East, it's just as bad. You got the Nikkei down 20%. 20% is huge. You got investors very, very, very scared. In fact, look at the fear and greed on the stock market. The fear and greed is at 27 on the stock markets. We're almost in extreme fear and extreme panic, and that is echoed by the VIX. The VIX is an indicator called the volatility index. And what the volatility index shows is effectively how scared US investors are. And look at the VIX, how it's gone up from 10 all the way down to all the way up to 20. So the VIX, the volatility has effectively doubled. Crypto also back down to fear. So we were in greed and we went back down to fear. As you can see, the bubbles are red. Bitcoin though, holding above, still in that range. So we're still in that range. Even after everything, we're still in that range. I'm going to talk to you a little bit about what I'm seeing playing out here. You got Bitcoin dominance going up again as people move away from altcoins into Bitcoin, into safety. And then you've got the institutions reducing their exposure to Bitcoin. You can see the CME futures open interest is dropping. And lastly, what you're seeing is that it's so scary out there. Investors are moving away from risk assets. They're moving away from the NASDAQ, away from risk assets, and even they are moving out of the Bitcoin ETF. We had a big day of outflows yesterday. We went down 237 million on the Bitcoin ETF. So that is the situation. That's where we are. That is why I decided to come to you guys on a Saturday. Now, let's understand why this happened, because we know what happened, but what triggered it? What was the thing that caused the markets to do this overnight? Because this is shocking. This is basically showing you that the markets got a shock. Why did the markets get a shock? Why did the markets get a shock? By the way, I do see everybody here. I see all the people that are here to hang out on a Saturday. 𝗬𝗚𝗕𝗓, who says he's so happy. 𝗕𝗘𝗢𝗙𝗢 says, I like the sweater. I've been wearing the sweater for 3 days. It's freezing here. 𝗕𝗢𝗙𝗢𝗙, who's always here saying mentors of excellence. Chuck Strickland, always here, closing the gap this week. I see you guys. I see everybody here. Again, if you haven't smashed the like button, let's go. We've only got 695 likes and there's 2,500 of you. Anyway, let's get back to the show and let's understand why it is that what happened. What happened yesterday that triggered the markets to collapse like this? Well, at the surface, and this is again at the surface, because this is, sometimes there's one straw that breaks the camel's back, or you hit something and it just breaks because it's had cracks for all over, and you just need one little thing to spark the collapse. And that is what happened yesterday. So what actually did happen yesterday was, very simply, we had a miss in the jobs numbers. And you can see, let me just play it for you.
On non-farm, we came in at 114,000 jobs. Got it. We came in much weaker than expected on non-farm. We came in at 114,000 jobs on non-farm. The estimate was 175,000 jobs on non-farm. The employment rate unexpectedly went up. We went up to 4.3%. We were looking for a rate of 4.1%. Government jobs, 17,000 on the government job story, and that is actually a lot less than what we got last month. Remember, last month on government jobs, we had 70,000. Now we've only got 17,000. All right, private sector jobs.
Up until now, the market has been fixated on reducing the inflation rate. And so Powell's been increasing rates and holding rates steady to reduce the inflation rate, and no one has spoken about jobs until the last FOMC, where we heard Powell saying that the jobs or the unemployment rate is starting to stabilize, and that's what's happening. And that's what happened yesterday. We got the jobs numbers. The unemployment rose 4.3%, and the forecast for the rise was 4.1%. Okay, so what? So we've got a little bit more unemployment than we wanted. That's great. I mean, we wanted a little bit more unemployment so Powell could start reducing interest rates. And it's not such a big difference between the forecast of 4.1 and 4.3. And remember, markets only care about what you deliver relative to what they expected. So they expected a 4.1% unemployment, and they got a 4.3% unemployment. So what? So why is everyone panicking? Why are the markets all of a sudden panicking? That's the big question. And the answer to that big question is because that move in unemployment triggered what is known as the 𝗟𝗓 rule. And the 𝗟𝗓 rule is designed to signal the start of a recession that has officially been triggered. Now, the 𝗟𝗓 rule was I got this off Google. The 𝗟𝗓 rule is a rule if you want to call it that. It's a rule which was designed by someone called 𝗕𝗬𝗕𝗓, a macroeconomist who works at the Federal Reserve. And it is an indicator of when it signals, the indicator that looks at signals related to the onset of a recession. According to the rule, the early stages of recession are signaled when the 3-month average of unemployment rate moves above the lowest 3-month moving average unemployment rate over the last 12 months by 0.5 percentage point or more. So it's like a moving indicator of unemployment. And basically the rule says that if jobless rate based on a 3-month average is 0.5 percentage point above its lowest point in the previous 12 months, the economy has tipped into a recession. So then you ask yourself, are we currently in a recession according to the 𝗓𝗏 rule? The current 𝗓𝗏 rule reading is 0.53, which is above 0.5, according to the Fed data, having surged for 0.43. What does that mean? Well, let's have a look here. What does that mean? If you look at the numbers here, so you've got the 0.5% over here. You've got all the things. The 𝗓𝗏 rule indicator signals when the US is in a recession. If the 3-month moving average of unemployment rate rises by 0.5 percentage points or more, relative to its low in the last 12 months, it signals a recession. And it's now triggered at 0.53. So, because yesterday, when the job numbers came out, this 𝗓𝗏 rule, which was created by an ex-Fed employee called 𝗕𝗬𝗕𝗓, indicated that we are in a recession, then the market started talking about recession. Everybody started talking about recession. And as 𝗕𝗬𝗕𝗓 says, we've talked about this in the pod for a few months now, but we have quietly been in a recession for at least the last quarter. So now, no one was talking about the word recession. People kind of said, there's a recession on the horizon, which I found kind of weird because I've never, ever seen a recession where the GDP is growing at 2.8%. But okay, let's just park the fact that GDP and the economy looks superheated. As it stands, the 𝗓𝗏 rule has been triggered. And if the 𝗓𝗏 rule says that we're in a recession, then, I guess that we must be in a recession, right? Because the 𝗓𝗏 rule made by an ex-Fed employee says that we're in a recession. To make this all much worse, the jobs numbers for May were revised lower. And so you can't make this up, 𝗕𝗬𝗕𝗓 says. He says the job numbers for May were revised lower. 5 out of the last 6 jobs reports have been revised lower. Not only is the unemployment now at a 3-year high, but revisions are the new normal. Hundreds of thousands of jobs have been revised lower. So not only have we now triggered the 𝗓𝗏 rule, but they're also saying, look, we made a few mistakes on the previous jobs reports, and we actually want to revise them lower. And so basically the whole unemployment thing, or the whole employment thing, has become an absolute a shit show. Now, you will recall that about 3 days ago, on Wednesday or Thursday night, we were here for the FOMC. And when we were here for the FOMC, Jerome Powell doubted whether or not there's going to be a rate cut in September. He said, look, we'd look at the data and there's no rate cut in September. And the market was also kind of skeptical about whether there would be a rate cut in September. Anyway, let's just say that things have changed drastically, because what the market is now saying, let me just refresh that. What the market is now saying is maybe the Fed has once again arrived late to the party. Like, it feels like the Fed has once again arrived late to the party. What I mean by arrived late at the party, generally, it takes time for the Fed's actions to filter into the economic data. So if, for example, if I cut interest rates today, tomorrow nothing's going to happen by tomorrow. It's going to take a long time for that interest rate move to filter into the economy. And so typically the Fed has always been criticized for acting too late. And some people said the Fed should have cut interest rates specifically to avoid a recession. Because remember, the Fed doesn't want too much unemployment and doesn't want inflation, and they're balancing this down. They don't want a recession, because in a recession there's lots of unemployment. Well, a few days ago, there was hardly any chance of an interest rate or interest rate cuts. Now, if you look at the probabilities of interest rate cuts, have a look at this. 1, 2, 3, 4. They're talking about 4 interest rate cuts this year. Sorry, 3 interest rate cuts this year. Yesterday, when the numbers came out, I tweeted, but you can see that table changed a lot. There was a probability of 75.5% of an interest rate cut here, and then a double interest rate cut in November. Almost like people are panicking and saying the Fed is going to panic and cut interest rates very, 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 very quickly. I'm looking at Polymarkets. Polymarket said there's a 95% chance of an interest rate cut by September. Let's actually look at more how many Fed rate cuts this year. 0, there's a 2% chance of 0. 1, there's a 4% chance. The biggest markets on Polymarkets are now betting that there's either going to be 3 or 4 interest rate cuts this year. So we've been talking about we want Powell to increase interest rates. Now the sound rule has been triggered. Everyone's talking about recession. And so you see that the chances of Powell increasing interest rates is broken. We always said that Powell would wait for something to break before he actually increased interest rates, before he actually reduced interest rates. And now it looks like the job market may actually be broken. And now Citibank and JP Morgan expect 50 basis points in September and 50 basis points in November. That's a huge, huge, huge interest rate. So from going nowhere, effectively, from no interest rates, or potentially the market saying maybe there's going to be 1 or 2 interest rates, now what the market's talking about is the equivalent of 4 interest rates happening this year. And everybody's talking about a recession. I'll play you a little clip from the All In pod, which I listened to a few hours ago.
That your read on where we're at, and is the Fed kind of appropriately reading the economic tea leaves, given the recessionary indicators that you just mentioned earlier, and what else we're seeing that the Fed's mandate obviously is meant to support both the monetary policy, but also employment in this country?
I think we're in a recession. And I think the problem with a recession is even as inflation diminishes, if your purchasing power is shrinking faster than prices fall, it still feels like prices are going up. I don't know if you guys have been reading the Wall Street Journal, but like the last couple of days, they've been doing a whole series on people that have been left behind by inflation. And I was really surprised as I read those articles, just the sheer quantity of impact in terms of the number of people it's touching independent of salary. And so my takeaway kind of just reinforced the fact that we've sort of like looked past the problem because of the stock market going up for the last few quarters because of 7 companies. And now that people are sobering up to the reality that even they don't have an answer for all the money they're spending.
So according to 𝗕𝗬𝗕𝗤, we are in a recession, and we've been fooled because the markets have been going up, because Amazon, Nvidia, Microsoft have all been going up. But now you can see that now the waves, the tide has come out, and we can see who's wearing pants and who's not, because Nvidia is now down 26%. So that is what the market is worried about. The market is worried about a recession, and that is why we got this happening. But I don't think that's the underlying reason. I think that this was just, like when you got a donkey or a camel, and the camel or the donkey is walking with a whole lot of shit on its back, and then you take like a little straw and you drop the straw on the camel's back, and it just breaks the whole camel's back. That's not the real problem here. The real problem is that there's something happening underneath. So while everybody is looking at this and saying recession, I'm seeing it completely different. And as you know, I don't believe that there can be a recession when your GDP is growing at 2.8%. 2.8% is very, very, very healthy. You can't tell me that is a recession. And I wrote about this, and I did a few videos on it. Specifically, I did a video here where we spoke about the whole situation in Japan. I wrote about this in a tweet as well, where I said, look, there's only one chart in the world that's really important today. And it is this chart over here, which is the chart of the Japanese yen against the dollar. And you can just look at what's happening on this chart. The Japanese yen against the dollar has weakened, or the dollar has weakened by 20% or so against the Japanese yen. In fact, it should be much, yeah. So by 10% or so against the Japanese yen. And this is the chart that is the important chart. And I just want to show you just quickly, just so that you understand why I'm saying that this chart is the most important chart. Let's look at the date that this chart turned. It is the 11th of July. You can see on the 11th of July is when this chart started to turn. Now, let me take you to a few other charts, just so you can see my thesis here. What date did the NASDAQ start turning? Oh, is this coincidence that it also started turning on the 11th of July? Let's look at the NVIDIA chart, and let's look at when the NVIDIA chart specifically started turning, 11th of July. So yes, maybe the recession thing caused us to go under this trend line yesterday, but what is the underlying thing of this whole thing? And that is, what is the thing that's causing this? And that is, for me, the Japanese cash and carry trade. And it's a very, very, very important that you understand it. And so for those of you who weren't here earlier this week, let me just go through it again. For 30 years, the Japanese have had zero interest rate on the yen. So if you wanted to borrow yen for the last 30 years, you could effectively borrow yen at 0%. Like the interest rates in Japan, let me just show you what it looks like. For the last 30 years, from 1995 until now, the interest rate in Japan has been pretty much zero, right? What does that mean? It means that you can borrow money in Japan for zero interest rates, and you can invest it in the NASDAQ and make NASDAQ type returns, and then just pay back your loan because there's no interest rate on your loan. And so that's exactly what Japan did. $4 trillion worth. So you can see that in Japan, for 30 years, investors borrowed yen at no cost and invested them globally in T-bills, in a broad basket of risk assets and a whole lot of other things. Then now, for the first time this week in a long time, the Japanese government actually increased interest rates by 0.25. So I'm going to go. That's what the interest rate increase looks like. It doesn't feel like a big interest rate, but they did increase it by 0.25%. And so what's going to happen now is the people that thought that they were borrowing for free, or that did borrow for free, now realizing they're not borrowing for free. At the same time, the US is going to start reducing its interest rates, which means that what they've got to do is they've got to take the $4 trillion that they've invested in risk assets outside of Japan, and they've got to bring it back to Japan and take it out of the NASDAQ. And as they sell their positions so that they can move the yen back and repay their loans, so risk markets are going down. And that's why all the charts, and I tweeted about this again. Let me quickly find the tweet for you here. I tweeted about this and I said, that is why all the charts actually line up. You can see that on the 11th, the US dollar, Japanese yen, the QQQ, and all the charts basically on the 11th actually started to drop. Now, the worst part is that if you look at the futures for the Nikkei looking like it's going to open down another 5% on Monday. Now, if you want to see how scary it is in Japan, if you look at the Nikkei is down. Hold on, let's see if we can get, yeah, here we go. The Nikkei is down 20% since, well, I guess this is probably the 11th of July. The Nikkei is down 20% since the 11th of July. That's not that scary, and I'll explain to you why. Because the Nikkei is denominated in Japanese yen. And of course, if the currency strengthens, any asset that's priced in the currency will drop. It's like when the Dixie goes up, risk assets reprice because they're all priced relative to dollar. If you adjust this, what you can see is that the drop's only 10% if you look at it on a currency adjusted basis. So yes, there has been a drop in the Nikkei, but it hasn't been 20% in real terms. If you adjust for currency, it's actually only been 10%. And so now what the world is worried about, the world is worried that Japan will increase its interest rates very fast, and this trade will be forced to unwind very, very, very quickly. So that's what everybody's worried about. I want to just show you something here. I want to see if we can just quickly go to 20. Let's see if we can go to 2000 and press OK. Let's see if we can get okay. I want to also just show you something else. So in fact, let's actually even go even further back. Let's go to 1990. Okay, let's go to 1990. The other thing that what you can see is that this is not the first time that this has happened. If you look at Japanese interest rates and you look at the 3 times that Japanese interest rates have gone up. So Japanese interest rates went up to 0.25% in 2001. Then Japanese interest rates went up again in 2008. If you look at the chart of the NASDAQ, what happened in 2001? We had a huge market collapse. And in 2008, we had a huge market collapse. And that's what the market's worried about now. They're kind of saying, look, every single other time that Japan has raised rates, that has corresponded with a global recession. And that has corresponded with a stock market correction. And so now people are looking at this and going, hold on a second. Japan has just raised again 0.25%. What happened the last couple of times that this happened? oh, well, and they're starting to unwind their entire risk trade. And so there's only really one chart that matters these days. It is the chart of the US dollar against the Japanese yen. What we hope is that this is just an overreaction and that this chart starts to normalize and does this. If that happens, it's almost like they are starting to unwind a little bit of the Japanese trade and almost they engineer a soft landing. If this chart continues to strengthen, God help risk assets. That's all I can say, because then a $4 trillion risk asset trade is going to unwind. People are going to start selling their NASDAQ. People are going to start selling their risk assets to pay back their yen investments. So we're looking at this chart over here, and we're looking at the Japanese interest rate chart. That is what we should be looking at. So devoid of the Japanese interest rate chart and devoid of the Japan situation, and again, I say we have to keep looking at the Japanese situation because that's the big elephant in the room. But if you're just thinking about the US recession and the SARM rule, which is what got triggered this week, I want to ask you a quick question. Haven't we been begging for the Fed to reduce interest rates? Isn't that like every FOMC, every meeting, we're like, hey, Fed, reduce interest rates so the economy can start speeding up? Okay, well, now you're getting an increased probability because now the jobs numbers are down and the inflation numbers are being reduced. On the 14th of August, there is another inflation reading. If that inflation number is down, we're getting a rate cut. And if we get a rate cut, isn't that exactly what we have been waiting for? Didn't we say that all we want is more liquidity? Didn't we say that all we want is the Fed to reduce interest rates and start printing more money? And so this tweet probably sums it up pretty well. She says, history is repeating itself. In 2020, all markets took a huge dump out of economic fear, COVID, and economic decline. In response, the Fed cut interest rates and pushed quantitative easing to support the economy. What followed was the 2021 bull market, which we all know about. Today, the markets are dumping out of economic fear again. In response, it's near guaranteed that the Fed has to start cutting rates in September and maybe start doing quantitative easing, which leads to a bull market. So in the absence of this Japanese trade unwinding quickly, and again, I say we've got to keep our eyes on the Japanese trade. We've got to do it. Arthur Hayes, who was on the show yesterday, I think you guys must have seen that he came on. If you didn't see it, go and watch this show. This was really one of the most fantastic shows that I've done with him. Go and watch this show over here. Really good show where he talks about the Japanese situation and the Fed actually cutting rates. But what he says is, if Japan tightens, the US has got to print as much money to save their economy, and then the US is going to start printing like absolute mofos. Okay, so this is temporary because either way, the US has to start printing money. But I want to show you something else, which I don't know, like I'm kind of baffled about this. Maybe you guys can help me work it out. The day the market started to turn was July the 11th, right? The day the Japanese yen started to strengthen was July 11th. So we kind of say, look, as the Japanese yen started to strengthen because they started to tighten, the market started to weaken. Risk assets started to weaken. The NASDAQ started to weaken. NVIDIA started to weaken, as you can see on the 11th of June. But then I went to the Bitcoin chart. And I took the Bitcoin chart and I said, I remember that there was a turning point for the Bitcoin chart, which was on a certain date. What was the date that actually Bitcoin started to turn? July the 11th. Now, initially I thought, hold on a second. Bitcoin started to turn because of the Trump assassination attempt, because people thought that Trump was going to be president. But no, the Trump assassination attempt only happened on the 14th. So I'm not sure what the story is here. I'm not sure whether people are starting to treat Bitcoin. Let me just click all these things here so that they're all open when we get them. I'm not sure whether Bitcoin started to turn on the same day as the yen started to weaken because of a coincidence, or because Bitcoin is acting as a substitute to gold and people are worried about an economic meltdown and they're running for Bitcoin. I don't know what the answer is here. I was quite surprised by this. I was just doing the analysis. What I do know is I know that global liquidity is now at an all-time high, and we're about to print more money again. Either way, we have to start printing more money again, regardless of which path or what happens. The only way to get out of this is to do quantitative easing and to start printing money again. So, whereas I do think that we are in for maybe some shakiness in the short term, this is exactly how I feel, realizing that we're living through the next great Fed policy mistake. And what are they going to do? We know what the Fed do to fix things. They print money. And when they print money, we get a repeat of 2020 when the markets start to go up. But I don't think it's going to be as aggressive as 2020 because, I mean, there's no COVID. We're not forced to stay at home. We're not all getting stimulus checks. But I do think that something is going to happen. But until then, remember, in 2020 as well, something has to break. And when that thing breaks, it's quite painful when it breaks. Like, I don't know if you remember this in 2020. Let's just quickly go to the monthly. Just makes it a lot easier, weekly. We have to go through this thing over here and feel the pain before the Fed actually start printing. And so hold on tight because we want a little bit more pain so that the Fed can say, okay, shit, we've overreacted again, or we've acted late again. And because we've acted late again, what we have to do is we have to start printing money and we have to start loosening like mofos quickly before something breaks, before people go insolvent, etc., etc. So I'm also hoping that it's not a coincidence, as I said in my tweet, that people actually ran into Bitcoin. Maybe Bitcoin is becoming the digital gold, and that's what's going to happen. On the other hand, I mean, some good news. I don't know if you guys saw this.
Who knows? Maybe we'll pay off our $35 trillion, hand him a little crypto check, right? We'll hand him a little Bitcoin and wipe out our $35 trillion.
Trump insinuating that Bitcoin could wipe out the US debt, and he's probably right. Also, Morgan Stanley becoming the first bank to let wealth advisors pitch ETFs to their clients, and other banks are starting to let their advisors pitch ETFs to the clients. That's some big news. We also could get a big short squeeze this weekend because there's a lot of high liquidation shorts, so we could get a big short squeeze. The other positive thing that I saw was that all the shit didn't deter the ETH ETF buyers. Those ETH ETF buyers are coming in and they're buying and they're buying and they're buying. Yeah, and then someone says after this reset, get ready for a 12 to 18 month move to 150K for Bitcoin. So we could be living through the reset. You've just got to survive this reset, survive the pain, because we need pain so that the Fed can start. We need to go through this so that the Fed can be forced to act really, really, really quickly. And so you got to hold on and you got to survive. And if you can buy the dip, because you know that when you buy in terrible situations is when you land up making the most money. When I bought Solana at $13, that's when I made the most money. When I bought Bitcoin at like $3,000 when the Nasdaq collapsed, that was one of the best Bitcoin buys that I've ever done. I like chaos situations. Now, a couple of things. One is that all this data, all this information was all published yesterday in Frontrunners. I know a lot of you aren't in Frontrunners. I think that you should consider going to Frontrunners. Why? That is our Discord group. That is effectively the Banter Discord group, Run's Banter Discord group. It's where we hang out, where we get together, where we drop information first when we can't be live. If you want to join, you can sign up. Hold on. You can sign up here, but you only get into a waitlist, and we only let in people onto the waitlist every now and then. Just sign up here. Trust me, it's the best move you ever make. If you don't enjoy it, leave after the first month. We'll give you back your money. Honestly, I'll give you back your money if you're not happy after the first month. So that's the first thing. The second thing that was in Frontrunners is 2 trades that I'm taking, and I think I should tell you about them now, because again, I said I like bad situations. The first one is Kujira. Kujira is going through a leveraged liquidation at the moment. Why? Because they leveraged the treasury tokens to add liquidity into the ecosystem. And now, because the price has come down so much, they're going through liquidations. But I believe this will be fixed. And in fact, not that I believe this will be fixed. I know that people right now are fixing it, including JP, who's the founder of Rune. Now, I think when this resolves, the Kuji price goes back up. And so I posted that trade in Frontrunners. And I think it's very similar with the Astroport. I told people to buy Astroport at 3 cents. And because I think that when nothing really happened here, the hacker got away with $200,000. This is a good opportunity for you to buy the dip. Now, all this is in Frontrunners. Go to Frontrunners, sign up. If you're unhappy in 1 month, send me a text. I'll refund you your 1 month, and you can leave in peace. Also, we are opening another free cohort of Sheldon's Sniper School. Sheldon Sniper School is one of the best ways to
Not in
trade.
the beginning. You need to have purpose behind every single cent in your portfolio. If there's no purpose behind any dollar in your portfolio, it's going to go with the market because you're not going to know when to sell it. You're not going to know when to buy it. You're not going to know when to take profits. And this is where this whole entire course, school, everything is going to change all.
Amazing school. It teaches you life lessons. It teaches you how to trade. If you want to join the school, it's still free. I mean, I don't know how he does it for free because the next one is going to be quite much more. Is there a school link here somewhere? Yes, join Sniper School today. Just click on this link over here. Click on this link over here. You will realize that you start the school you're starting in 3 days, guys. So click, sign up. Let's get this done. And then the winner gets a funded Bitfunded account, a $20,000 funded Bitfunded account so they can actually participate. All right, guys, I'm going to get back to my family. You should too. I just thought I'd bring you this crypto love and this crypto wisdom. If you enjoyed it, do me a favor. Smash the like button one more time. Subscribe to the channel if you're not already subscribed. I will see you guys again on Monday. Until then, hopefully nothing happens and we can trade well, my friends.